Whether you're a first-time investor or an experienced one, mutual funds are often considered by experts to be an investor's best friend due to their many advantages. But with so many different options available today, how do you make the right choices for your portfolio? You start with the fund's investment objective. The investment objective of a mutual fund is what the fund intends to achieve through its investments. For instance, an equity diversified mutual fund may have the objective of investing in growth stocks or shares to achieve capital appreciation, while a debt or a fixed income mutual fund, on the other hand, may have the objective to invest in debt instruments to earn regular income for its investors. While considering the investment objective of a fund, you need to consider other factors as well. Let us consider a scenario in which you are retiring in the next 3 to 4 years and you need to secure your income. On a friend's advice, you decide to invest in a slightly risky sectoral equity mutual fund, let's say a technology fund, because in the last 2 years, it had outperformed the relevant index. Now imagine that when you retired and hence needed the income from the fund, there was a reversal in the fortunes of technology companies and your invested value fell. Your income would have declined and you may have lost some of your invested capital as well. Considering your life stage and risk profile, you would have been better off investing in a low-risk debt or fixed income fund. Unlike a sectoral fund which can be risky unless you remain invested for 5 to 7 years, a fixed income fund is suitable for shorter time horizons as its price does not fluctuate much and it can help generate moderate returns as well. Remember that the product you chose wasn't at fault, it simply did not match your needs. So when you consider the investment objective, you will also need to consider if the fund matches your financial goals, the time you may take to achieve them, and other elements like your risk profile. Many mutual funds have a specific investment style, and you should match that as well with your needs and risk profile. You could build your mutual fund portfolio according to market capitalization or according to fund management style. The second factor to consider while selecting a mutual fund is its role in your portfolio. Just like on a chessboard, every character has a certain role to play. Different mutual fund products play different roles in your portfolio. Identifying what role a product needs to play will keep your portfolio clean and well balanced. Think of teamwork every time you consider your portfolio, and then think of the reason why a particular fund is there or needed for your portfolio. The next factor to consider is the time horizon of your financial goal and your risk profile. Assuming you are in your 20s or 30s and are saving for your retirement, your ability to take risk is higher, and hence you may think to invest in a high-risk equity fund to build wealth because you will be largely immune to short-term market ups and downs. However, if you're much closer to retirement, then you should invest in a low-risk fixed income fund. In general, the closer the goal, the lower the risk you should take. You can then analyze the performance of a fund based on the following parameters. The fund should have performed consistently in the past compared to its benchmark index and also compared to the category average, which in simple terms means the average returns of all schemes within that category. A fund that consistently outperforms its peers and its designated benchmark over the short and long term is generally considered to be well run and most likely to bring you positive returns. But do remember that while past performance can be a good indicator, it is not a guarantee of future results. The volatility in returns or fluctuations in NAVs of the fund should be in sync with its objectives. For instance, if the fund is a high-risk, high-potential return fund, then volatility is a given. However, if it is a low-risk fund, the returns should not be volatile. This can be checked with the help of risk ratios published in the fund fact sheets. It is also important to assess the fund manager's track record, both in terms of his experience and reputation and the past performance of the other funds he may be managing. The fund should be large enough for you to be able to liquidate your investment whenever you need to, and also for the fund manager to implement his investment strategy effectively. Generally, high assets under management indicate a higher number of investors that trust the fund manager of that fund. Fund expenses are expenses incurred by fund houses to manage the fund. These expenses are chargeable to the fund's investors as a percentage of assets under management and are described as the total expense ratio or TER of a fund. So, if you invest in a fund that actually earns 14% return with a TER of 1.8%, you will ultimately earn only 12.2% per annum. Generally, when you come across a mutual fund's returns in a fund fact sheet or brochures, the figure mentioned there will have already taken TER into account, as the fund's NAV is calculated having considered the TER. The thing to keep in mind is that when you are comparing two funds with similar returns, look out for their expense ratios and ideally consider the one with the lower TER. Tax impact. Different mutual fund categories are taxed differently, which can also influence your selection. For instance, in 2016, equity-oriented funds can be more tax efficient than debt-oriented funds. In fact, if you invest in an equity-oriented fund and hold your investment for more than 12 months, the profits on your investment are completely tax-free. However, holding for less than 12 months attracts tax at 15%. In case of non-equity-oriented mutual funds, such as debt funds, the profits you make on investments held for less than 3 years attract taxes based on the income tax slab relevant to you. On the other hand, if you hold your investment for over 3 years, your profits will attract a tax rate of 20% with indexation. But what is indexation, you might ask? Indexation refers to a practice of adjusting your investment purchase price for inflation, which helps reflect the true value of the profit you've earned. Generally, the application of indexation will end up in reducing tax liability on debt mutual funds. So it makes sense for you to also understand the tax implications of investing in different types of funds. Remember that tax rates applicable on different investments are subject to revisions and may change every year. Your investment advisor can explain tax implications to you in greater detail and keep you updated on any changes as well. Before we end this video, it's important to highlight that while the factors mentioned here are all important indicators by themselves, it is best to not consider any one factor in isolation before choosing a mutual fund for your portfolio. A professional investment advisor can help you go about selecting the right funds for your portfolio in the best possible manner. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.